Well, let's start with the day's market action. Shares on the Lal Street staged a sharp recovery on expiry to end in the green. Nifty and Sensex ended 0.25% higher. The last hour surge was led by financials, with the Nifty Bank seeing gains of close to 1%. Mid-caps, meanwhile, underperformed. However, for the December series, Nifty and Sensex saw cuts of about 1%, but mid-caps and banks outperformed to end with gains. In the currency market, rupee remained on a tight leash against the dollar, trading just below the 83 mark. Well, here's the big story this evening. India's current account deficit has soared to a record high in the second quarter. Rising trade gap took India's current account deficit beyond $36 billion in the second quarter of this financial year. The deficit has doubled from $18 billion in the first quarter. It is also nearly 4 times higher than the $9.7 billion reported in Q2 last year. With this, current account deficit for the first half of the fiscal also rose to 3.3% of the GDP. For the second quarter, the CAD is at 4.4% of the GDP. Well, to take this discussion ahead, I'm now joined by Aditi Nair, Chief Economist at ICRA. Ms. Nair, thank you so much for joining us. This is quite a startling jump that we're seeing as far as the numbers are concerned. 4.4%, unprecedented numbers. It's in fact even higher than ICRA's own estimates. Are you surprised? Are you shocked? What are the factors responsible?
Well, you're quite right. We had actually expected the current account deficit to be at an all-time high in absolute terms in this quarter. The range that we had forecast was $31 to $34 billion. So this is well above the top end of our range. But equally interestingly, the current account deficit for the first quarter has been revised downward by about $5 billion. So, I'm a little puzzled as to what to make of these numbers and really how to project forward, because the Q1 number had come in below our estimate and it's been revised down further. The Q2 number has come in higher than our estimate. And I think at best, what we are willing to say right now is that Q2 should be a peak as far as the current account deficit is concerned. Q3, at least, the merchandise trade deficit in October and November is trending lower than what it was in the previous quarter on average. And I think that's a positive sign. The other thing is that the services surplus in Q2 is actually very healthy. It's actually better than what the provisional numbers had suggested. So I think that's something that is a positive takeaway, as we're getting into a period where exports are going to slow both on the merchandise and the services side. So broadly, we would expect the second half to see a current account deficit in both Q3 and Q4, which is probably going to be in the range of $25 to $30 billion. And for the year as a whole, we're looking at about $115 billion at this point in time.
Sure. Let me take this a step forward. In terms of merchandise exports, that's the clear culprit here, going up to $83.5 billion. The question I want to ask is this gap that we're beginning to see increasingly going forward. Is it essentially on account of weakening exports or on account of perhaps pent-up domestic demand that is causing the import figure to balloon?
So there's both factors that are at play. The export number, we actually expect the monthly merchandise exports between December and March. So for these 4 months, we expect them to contract by 7% on a YOY basis. And it's both slower demand coming in from the major trading partners, as well as the fact that commodity prices have softened to some extent. So both of these will have a negative impact on the headline merchandise export number. And while lower commodity prices will help our imports, domestic demand is relatively more robust. And therefore, the volume growth or the value growth will both be higher than the export number. And therefore, the merchandise trade deficit is going to remain somewhat sticky. I would expect it to broadly be around, average about $25 billion per month in the rest of this year. And that might be a reasonable estimate to expect for the next fiscal year as well. How much the services surplus holds up is going to now be quite important in terms of trying to gauge the overall current account deficit.
Sure. Let's also look at the year ahead. You're talking about the next fiscal. The situation is not looking very positive in terms of the global performance and in terms of global growth. Can you give us a sense that when you look at softening of global demand, is that likely to, in fact, skew this figure even further, with exports suffering even further going forward?
That does seem to be likely. So basically, what we expect is that the export demand is going to be weaker than our domestic demand. So that itself is going to lead to export growth being lower than the import growth. And secondly, with commodity prices trending lower, that's going to soften both the headline export and the import number. But that actually might help to bolster the domestic demand with commodity prices trending down. So it's going to lead to a trade deficit that's going to remain sticky on the upside. Don't expect the numbers to be as bad as some of the monthly numbers that we saw in Q2 when we did see commodity prices being higher than where they are right now. But I think an average of about $25 billion per month for the merchandise trade deficit is something we should be prepared for.
Right, Ms. Nair, thank you so much for all your insights. So CAD likely to remain sticky on the higher side. That's the word coming in from Ms. Nair from ICRA. But let's move ahead now. Here's some positive action, in fact, from the macro front. Bad loans in India's banking system is at the lowest level in 7 years, according to the RBI. In its financial stability report, RBI said that gross non-performing assets of banks have dropped to a 7-year low of 5% as of September. Net NPAs have also dropped to a 10-year low of 1.3%. RBI attributed the decline to strong recoveries, write-offs, and lower fresh slippages. In the biannual report, RBI did warn, however, about global headwinds facing the Indian economy, but the central bank believes India's fundamentals are strong and inflation is on the decline. Meanwhile, the union government is planning sweeping changes to the insolvency and bankruptcy courts. Sources tell us that the bankruptcy process could be split into 2 parts to ensure quicker resolutions and fewer litigations. Sapna Das is joining us now with more details. Sapna.
Well, the government may have certain significant amendments in mind to the IBC. What could be under discussion is as follows. Number one, probably structuring a resolution plan in 2 parts, basically the bid and the distribution of money. Here, probably the suggestion is that the adjudicating authorities should give a quicker approval to bids once they come in from the COC. This will help the new promoter come into the picture immediately and not wait for the distribution of money to actually start. The money that's undisputed can be given out to stakeholders in the first stage itself, but the disputed part of the money can be kept separately in an escrow account, wait for the litigation to be over, and then that can be taken forward. So this is one. Second, introducing a challenge mechanism into the IBC. There has been a lot of discussion on this in the past as well, but not included in the law so far. So there is a serious consideration that this should be made part of IBC. This will help cut delays and also maximize the value of potential bids. Last but not the least, also, probably the government will need to clarify on the immunity already granted to new promoters under IBC. In the past, some courts have allowed fresh proceedings, legal proceedings against the new promoters. So this has raised questions in the minds of potential bidders. The government will need to clarify on this once again, because that will be very important and significant in giving comfort to potential bidders to come forward, to salvage companies under IBC. These are some of the proposals that we are given to understand. We have to wait and watch and see how all of this pans out.
Right, Sapna, thanks a lot for that update. Meanwhile, months from after Maiden Pharma, another Indian pharmaceutical company, finds itself in the dock, the Uzbekistan Health Ministry has claimed that 18 out of 21 children who were administered a cough syrup manufactured by Indian company Marion Biotech have died. Now, the Uzbek government alleges that Doc 1 Max, the cough syrup, was allegedly contaminated with the toxic substance ethylene glycol. The Uzbekistan government has also claimed that the syrup was given to children without a doctor's prescription, with doses that exceeded the standard for all children. The legal head of Marion Biotech has said that they will extend full support to the government inquiry.
देखो हमें भी अफसोस है, कहते हैं अब किस वजह से डेथ हुआ, अभी जो है गवर्नमेंट यहाँ इंक्वायरी कर रही है, अंडर इन्वेस्टिगेशन है. जो रिपोर्ट आएगी उसके बाद जो है रिपोर्ट आने पर जो है सही चीज़ें मालूम होंगी. हमारी तरफ से कोई प्रॉब्लम नहीं है. हमने गवर्नमेंट इंक्वायरी कर रही है, है ना, कहते हैं गवर्नमेंट का जो रिपोर्ट आएगी उस हिसाब से रिएक्ट करेंगे.
सैंपल कलेक्ट किया है?
हाँ, गवर्नमेंट कर रही है, लगी प्रोसेस में लगी हुई है. हाँ जी.
Well, let's focus on the company in question here. Sources tell us that the Noida-headquartered Marion Biotech has been manufacturing cough syrup since 2012. When we last checked the company website, it claimed to have been certified by World Health Organization. As per the company's LinkedIn page, it is a flagship company of the Eminox Group. A preliminary check by CNBC TV 18 of the government website that records adverse incidents involving pharmaceutical companies has not found any mention of Marion Biotech. However, we are awaiting clarity from the government if there have been any past lapses recorded. This is the second time that an Indian pharma company has found itself under the lens for deaths of children overseas in recent months. The World Health Organization had found unacceptable levels of diethylene glycol and ethylene glycol in some of the cough syrup samples recovered from Gambia. Meanwhile, the Indian drug regulator, however, claimed that samples of Maiden Pharma's cough syrup did not contain traces of the toxic substance and that they were found to be of standard quality. WHO has, however, stood by their own probe findings. The Ministry of External Affairs said that they are in touch with Uzbek authorities and providing consular assistance.
Uzbek authorities have not formally taken up the matter with us. Nevertheless, our embassy has contacted the Uzbek side and is seeking further details of their own investigation. And of course, we understand that legal action has been initiated by the Uzbek authorities against some people, including the local representative of the company there. And in that context, of course, we are extending necessary consular assistance to those individuals or individuals.
2 rounds of inspection have already been completed by officials from CDSCEO as well as the UP Drug Control Department. The samples which were taken have been sent for further testing to the Regional Drugs Testing Laboratory in Chandigarh. CDSCEO is also in contact with the Uzbekistan-based drug regulator, and WHO is in contact with Uzbek authorities. The company so far has stated that it has already stopped the production of the stated cough syrup and is fully cooperating in the investigation. It remains to be seen what are going to be the results of the collected samples, based on which any further action will be taken either by the union government or by the UP state government. Till now, the Uzbekistan authorities have already stopped the circulation and sale of the stated cough syrup, claiming that it had a huge presence of ethylene glycol, which is a poisonous compound, and it led to the loss of lives of children in the country. It remains to be seen what are going to be the results of the collected samples, based on which any further action will be initiated. In Noida with video journalist Nitin Trivedi, this is Abhimanyu Sharma for CNBC TV 18.
Right. Now, well, moving on, India has imposed mandatory COVID tests for travelers from China and a few other countries to rise in COVID cases. Now, the union government has made RT-PCR tests mandatory for travelers from China, Hong Kong, Japan, South Korea and Thailand. The travelers who test positive or show symptoms will be quarantined. India is not alone in this exercise. The US and a few other countries have also imposed restrictions on travelers from China. But many others have not imposed any curbs so far. Danish Anand is joining us now with more details. Danish.
With the resurgence in COVID BF7 variant in China, countries like US, Japan, South Korea, Taiwan, Italy and India have announced various measures for international travelers. Passengers coming from China to Japan will have to submit a negative RT-PCR report from 30th December. Similarly, the United States has made COVID tests mandatory from 5th January for travelers entering the country from China, Hong Kong and Macau. Italy and South Korea have also announced that all passengers from China would be tested for COVID. In Taiwan, people arriving from flights or boats from China will have to take COVID tests on arrival from 1st to 31st January. India had previously announced random selection of 2% of international passengers on a flight for COVID testing, but today the Indian government has decided to make negative COVID test reports mandatory for travelers coming from China, Singapore, Hong Kong, South Korea, Thailand and Japan. However, there are still many countries like UK, Australia, France, New Zealand that have yet to take a call on fresh restrictions. Health Minister Mansukh Mandavia today held a meeting with pharma manufacturers to review availability of medicines and vaccine stocks in the country.
Right, Danish, thanks a lot for that update. But with that, it's time now to slip into a very short break. But coming up on the other side, Indian exporters will have a duty advantage over China, Vietnam and Bangladesh after the free trade agreement, says Australia's ambassador to India. More on that when we come back.